Now, welcome. This is part one of what we call the market structure basis. So basically, today what we're talking about is market structure basis. Market structure basis. That's basically what we're talking about for today. Now, under market structure, let's dive in quickly here. Under market structure, we have different series of things, but the basic meaning of market structure is the structure tells us the story. That's just what the market structure is. The market structure tells us the story of the market. It tells us, is the market currently buying? Is the market currently selling? Or is it ranging? What is happening in the market? That's what market structure does. It tells us what exactly is happening. That's what the market structure is. Now we are talking about the basis of the market structure. Under this basis, there are things we usually call the uptrend, downtrend, and the ranging markets, the range or consolidation. Now, these are the basics of the market structure, the direct basis. There is no other thing apart from these three bases of the market structure. The market is either in an uptrend, downtrend, or consolidation. There is no other thing. Keep this to mind. The market structure does what? It tells us the story of the structure. Now, under this market structure, the basis that we have are the uptrend, downtrend, and the range, or what we call the consolidation. That is what we have as a downtrend. As the basis of the market structure. Now let's dive into it. Let's deal with one. Our first one we have here is what we call the uptrend. Now, what is the uptrend? The uptrend, this is the upward movements of the markets. Or in other words, we can directly call it the bullish market. That's what our uptrend is. The uptrend is the upward movement of the market, or in other words, the bullish market, which is there's a constant creation of new highs and new highs. That is the uptrend. Now, in a direct figure or in a direct image, our uptrend consists of what is called high, higher high, and higher low. Higher high, sorry. It consists of what is called the higher high and higher low. Normally, we have the highs, we have the lows of every trend. But in order to identify the uptrend, we have to do what? To identify our higher highs and higher lows. In short form, we usually call this the HH, and the other one is HL. That's what we call them in short, HH and HL. Now, talking about this uptrend, how do you identify an uptrend? How do you identify the uptrend? In order to identify the uptrend, we just need to identify the higher highs and higher lows. There are other principles to this identification of an uptrend, but you have to follow it up one by one. Now, the first one we have, that's what I just basically said, and that's what identifying our higher highs and higher lows. Now, when identifying our higher highs and higher lows, let me give you a practical example here. This is just a layman example of how the market moves, but it's never how it moves. It doesn't just move in a straight complex line like this. But now, in this figure, how do you identify if the market is bullish what do? You identify your what higher high and higher low. When you look at here, what do you see? That's where we call our higher high. Here is where we call our what higher low. Why is here called the higher high and here higher low? That brings us to what our number 2 in the identification of the uptrend. The number 2 that we have here says the new higher high must be higher than the previous high. It must be higher than the previous high. While so as continuing, it says what the new low must be higher than the previous what? The previous low. That's how to identify if you're in an uptrend. The second one to do is identify, or it's just like a theory rather. It's like something that follows up with what we are saying. The first one says identify a higher high and higher lows, which is what we have done. We have identified the higher high, higher low. Now, what is the second thing here? The second thing says the new high must be higher than, okay, there's a mistake here. The new high must be higher than the previous high, while the low must be higher than the previous low. Now take a look at this. This higher low is higher than this previous low, right? This higher high is higher than what the previous high here. Now take note again. We have a new what higher high, and we also have what a new higher low. You can see how the market is moving now, and then we have what we also have a new higher high. So now what's the next thing that's going to happen? The next thing that's going to happen is we have a new higher low and continuation of the market movement, which is to identify this uptrend. It's very simple. We have the higher high, higher low, higher high, higher low, higher high. Very simple something. It's just a very straight manner of something. Identification of the uptrend, identify your new high, your new low, and take note of the criteria. This is never supposed to be number 2. This is like a criteria. The higher high that you're identifying must be higher than the previous high, and the low you're identifying must be higher than the previous one, previous low, which is what we have here as the higher low. We have it here as the higher low. It is higher than what this one. This higher high is higher than what this one. Now we go to the second type of the market we have, and now the second type is what? The downtrend. In the downtrend, this is basically what the bears movement of the market. We call it the bears move of the market, or the downward Now you can all read what's here, right? It says the bears move of the market, or the downward move of the market, consisting of the lower lows and the lower highs. Which basically, if we look at it, it's in a layman term, this is exactly what we are saying. This is basically what we are saying. Even a 5-year-old could understand. Now, in looking at this, you can identify where the up, which is the higher low, is the higher high. Sorry, the lower high, and what the lower low. Remember, the criteria here now is it's not like the up one where the criteria was that the highs must be higher than the previous highs or the low must be higher than the previous low. Now, the criteria for here is the low must, okay, let me say the lower low must be lower than the previous low, so as the previous high must be lower than the previous high. Now, this is the criteria, just vice versa of what the uptrend was. directly vice versa of what the uptrend was. Now you can have what we have here is what we call our lower high, which is LH, and then what we have here is what we call our LL, which is what lower low, lower high, lower low, lower high, lower low, lower high, lower low. Simply identifying what is happening. LH is what? Lower high. We have a lower high. Now, did it meet the criteria? Yes. This high is lower than the previous high. This high is lower than what the previous high, which is it meets up with the criteria. That's why. Now, is this low lower than this one? Yes, it meets up with what? The criteria. Now, take a look again. Is this low lower than this previous one? Yes, and therefore it meets up with the criteria. Now, this is how you simply identify the uptrend, the downtrend. What is their code names or their other names? The other names are what? The uptrend, the bulls market, the downtrend, the bears market. Now we have what we call our last one is the ranging market. Range. In the ranging market, this tends to have no defined movement, which it has no defined movement, telling us that it is neither bearish nor is it bullish. Now, an example of such type of market is something like this. Whereby it doesn't really have a defined movement. It doesn't have a defined movement entirely. Now, in most cases, a consolidation in the higher time frame might look like a trend on the lower time frame. Let's leave all of that. We'll delve into all of that later. But for now, looking at this, you don't see any defined movement here at all. We don't see any defined movement. We are seeing the ranging markets right now. We are seeing the bulls market. We are seeing the bears market. Now, if there's something you should keep to mind as a pro tip from this episode is to take is we as traders, our first job is to identify what the market is doing, which is, i.e., whether it's bear markets or bulls markets, or even as far as ranging markets. That is our first job as traders. We have to identify, is the market trending? Is the market ranging? Whenever the market is trending, the market only has two ways when it's trending. It is either going up or coming down. That's a trending market. It's either going up or coming down. Now we have a ranging market. A ranging market is that which does not have a defined movement. It's just moving in zigzag formation. It doesn't really have a defined movement. Now, the next thing that I gave here as a pro tip is that we as traders, that's our first job to do. You identify what the market is doing. And then what's our next job? Our next job is what? Follow the market. Which is, we don't trade against the market. We trade in line with the market. So if the market is bullish, you buy. If the market is bearish, you sell. That's basically all. It doesn't really have to be that difficult. That's just basically all we as traders usually do. If the market is buying, we buy. If the market is selling, we sell. There's no much thing to do again. I hope with all of this, you understand what the market bases are. This is just the part one, the opening of the market basis. In the part two, well, we tend to talk more on what we call support resistance. Let's follow up with this. Make sure you understand the three bases of the market, because without this, you can't understand where the market is going. So that is our first job as well as a trader. And our second job is to follow what the market is doing. So basically, enjoy this and let's go on to the next episode.